Let's be honest. Have you ever looked at a tax form and felt like you were reading a completely foreign language? Well, you're not alone. The Indian Income Tax Act has its own very specific vocabulary. And if you want to understand how your money gets taxed, you first have to learn to speak its language. So today, that's exactly what we're going to do.
You know, the entire world of income tax really just boils down to these two fundamental questions. First, who is legally on the hook to pay tax? And second, what is the actual thing that's being taxed? Now, the answers might seem simple, but trust me, in the eyes of the law, they are anything but.
And this is our starting point. You have to think of the Income Tax Act like its own little universe, with its own unique dictionary. Words you and I use every single day, like person or income, suddenly take on these specific and often way broader legal meanings. Getting these definitions right is the absolute key to unlocking the whole system.
This quote really gets right to the heart of it. The law deliberately gives these common words a wider meaning. So why do that? Well, it's to cast the widest possible net, to make sure that everything that should be taxed is taxed. So, okay, let's get fluent in this new language.
All right, so first up, the language of tax. In this first part, we're just going to explore why these definitions are so incredibly important and why you can't just rely on common sense when you're dealing with a tax code. So who is a person? Let's tackle that first huge question, who actually pays tax? In the world of tax, the answer is a person. And you can think of these as all the different players in the game.
The law kicks things off in Section 231, which defines what a person is. Now, the crucial thing to get here is that tax isn't just for you and me, for individual human beings. No, it's charged to every single entity that fits this legal definition. It really is a net designed to catch every possible taxpayer out there.
And when you see it laid out like this, you realize just how broad that net really is. The law actually identifies 7 distinct categories of person, and each one is treated as its own separate unit for tax purposes. Let's just quickly run through them.
First up, the one we all know, an individual. That's us. Then there's this really unique Indian concept called a Hindu undivided family, or HUF. Of course, you also have companies and firms. Then there's something called an association of persons, local authorities, and finally, this fascinating catch-all category called an artificial juridical person, which can include things like deities or universities. Yep, they can be taxed too.
All right, let's dive a little deeper into a few of these key players, because the legal definitions have some really interesting and important quirks.
The HUF is just a fascinating and completely unique Indian concept in tax law. It's not a business you form by signing a contract. It's a taxable entity that just comes into existence purely through family status. It includes a common ancestor, all of their direct male descendants, plus their wives and daughters.
But, it doesn't stop there. How an HUF actually works depends on which school of Hindu law applies. Under the Mitakshara school, which covers most of India, a child gets rights to the family property the moment they're born. But under the Dayabhaga school, over in West Bengal and Assam, those rights only kick in after the father's death. It's a subtle difference, but one with huge tax implications. Next up, the company. You think you know what a company is, right? Well, the Income Tax Act's definition is way broader than the normal business one. It specifically includes Indian and foreign companies, sure, but also any other institution that the Central Board of Direct Taxes, the CBDT, just decides to call a company for tax purposes.
Okay, so we've figured out who can be taxed. Now for that second big question, what exactly gets taxed? The answer is income. And just like the word person, its legal definition is probably much, much broader than you'd expect.
This is probably one of the most important things to get about income. The legal definition in the Act doesn't say income means this. It says income includes, and that's a very deliberate choice of words. It makes the definition what's called inclusive, not exhaustive, which means the list isn't final. The law can always decide something new counts as income.
So naturally, the definition starts with all the things you'd expect. Profits from your business, gains from a sale, dividends from shares, and perks you get from your salary. This is what most of us think of as income.
But here's where it gets really interesting. The definition also pulls in things like winnings from lotteries or horse races. It includes payouts from something called a keyman insurance policy. If you're a seller and you keep the advance from a property deal that fell through, yep, that's income. Even certain large gifts or government subsidies can be counted as your taxable income. Now this brings us to a really important distinction in the tax world. Understanding the difference between what's called a capital receipt and a revenue receipt is absolutely crucial because getting it wrong can be a very expensive mistake.
At its heart, the difference is this. A capital receipt is usually a one-off payment you get from selling a big, long-term asset, like your factory building. That's generally not taxed as regular income. A revenue receipt, on the other hand, is the recurring money you make from your day-to-day business, like selling the stuff you make inside that factory. That is your taxable income.
So how do you tell them apart in the real world? Well, there are a few key tests you can apply. First, just look at the source. Did the money come from selling a fixed asset or from your normal business operations? Then, think about the motive. Were you acting like a long-term investor or more like a short-term trader? And finally, if it's compensation, what was it for? Was it for losing your entire business structure? That's capital. Or was it just for one canceled contract? That's revenue. Getting these distinctions right is everything.
Okay, so let's put all the pieces of this puzzle together. We have the person, that's the player. We have the income, that's the taxable item. Now we just need the one final term that connects the two.
And that connection is the SSE. An SSE is basically a person who actually owes tax. But it also includes anyone who's involved in any kind of tax proceeding, whether it's for their own income, a loss, a refund, or maybe even for the income of someone else they're responsible for. And this simple line sums up the relationship perfectly. To be an assessee, you first have to be a person. But just because you are a person, let's say you're a company that made zero profit this year, it doesn't necessarily mean you're going to be an assessee with a tax bill.
So when you boil it all down, the whole system really just follows this simple logical flow. Step 1, you identify the type of person. Step 2, you figure out if that person is an assessee for the year. And Step 3, you calculate their total income, making absolutely sure you've correctly labeled every single rupee as either capital or revenue.
So we'll leave you with this final thought. Now that you know the basic grammar of tax, that a person can be a company and income can be a lottery win, how does knowing this hidden legal language change the way you look at your own financial world?